Hello, my name is Jeff McTague and welcome. This is the 9th installment of my series on what I know to be the best mutual fund selection process available on the market. Now today I'd like to introduce you to trait number 7, beta. You know, when we are on the expressway, we are often confronted with drivers going 55 miles per hour in the passing lane. We know they don't belong there. But you know, we will pass them on the right, look over and just shake our head, thinking they have no business in the fast lane. For me, beta helps deal with this issue when investing. Some people make investments in the fast lane when they have no business being there. This is how I see the value of beta. Today's automobiles have all kinds of unbelievable driver assistance, including a lane departure warning system. If you're in touch with the beta of the funds you represent, then you can use beta as your lane departure warning to help keep your clients safely in their lane. You know, beta is real, and it can spank both you and your clients if you are not disciplined to its use. I knew this 60-year-old woman who inherited a substantial sum of money back in 1998. She had never owned anything but certificates of deposit, but felt obligated to invest this money wisely. I put her in touch with a wonderful husband and wife advisor team, but because of her lack of investing knowledge and her risk-averse attitude about the inheritance, they put her in a low beta allocated portfolio. Things went smoothly, and she appreciated the hard work her advisors had done. That is until the 1999 Christmas party of the law firm for which she worked. The attorneys bragged about their triple-digit gains all night long, which made her 8 and 9% returns seem like failure. We all know what came next, don't we? She moved her money to the advisors who could produce some real returns for her. Of course, 1999 turned into 2000, which wasn't so bad, but then it ran smack into 2001 and 2002. By the time the bleeding had stopped, it was going to be quite a while before her inheritance was even back to where it was when she inherited it. Had she understood the value of beta, maybe this would not have happened. Maybe. Beta establishes a ratio between the risk taken by the fund and the risk taken by the investment index that most closely approximate the fund's investment objective. All things being equal, obtaining satisfactory returns while taking less risk than the investment category as a whole is obviously preferred. Once upon a time, the benchmark for almost all equity funds was the S&P 500. But obviously, not all funds invest in the S&P 500. Today, Lipper feels a need to create 174 different stock and bond mutual fund categories. And these 174 categories use 96 different best fit indexes as their benchmark. This volume of new categories makes things a bit tedious, but much more accurate. The market itself has a beta of 1. I look at it a little differently. I find it easier to look at the beta of the market itself as 100 or 100%. If a fund has a beta of 0.8, it suggests that the fund is taking only 80% of the risk of the assigned market, while a beta of 1.20 means the fund is taking on 20% more risk than the assigned index. We should all be cautious with actively managed funds that possess a beta at or near 1 or 100%, for they might be investing like an index fund or ETF of the category without the economy of index funds. Let me start with some current beta parameters you might find interesting. The average domestic stock fund has a beta of 0.98. Wow, 0.98. That suggests all domestic equity funds are taking 98% of their category's risk. How can you expect to beat the category if you're taking the category's exact risk? The average international or global stock fund beta is 0.9 or 90%. The bond fund average beta is 0.9 or 90%. And the highest beta for any fund last year was Fidelity Select Biotech at 2.65 or 265% of the risk of the assigned benchmark, the S&P 1500 Healthcare Index. Wow, huh? My beta research of the last 20 years reveals what we all assume is the case. In bull markets, funds with a high beta outperform funds with a low beta, while in bear markets, just the opposite is true. However, deeper research revealed an interesting find. Look at this chart I'm putting on the screen. For the years 1997 through 1999, the S&P 500 grew 108%, producing a rate of return of 27.56% per year. Now, I chose all the funds from 5 equity categories that were S&P 500 like. I broke the funds into segments based on their beta every 5 points, from a beta of 0.5 to a beta of 1.5. Here are the average returns for the bull period by segment. As you can see in this bull market, the more aggressive the fund beta, the better the return. And the more conservative the beta, the lower the return. Now let's look at the research results of the bear market of 2000 through 2002. Once again, the results are expected and confirmed. In a bear market, the more aggressive the beta, the worse the return, and the more conservative the beta, the better the return. Here are the average returns for the bear period by segment. Now here's where it gets interesting. Stay with me, it gets a bit confusing. I compared the average return for the funds in each beta segment to what they should have earned. And I'll get to that in a second. For instance, if the average return for the funds which took the same measure of risk as the market as a whole, that is a beta of 1, from 1997 through 1999, those funds generated a return of 21.58% on average. Then I took a look at the average return for funds with an average beta of 0.8. Since they only took 80% of the risk of the market, they should have returned 80% of 21.58 or 17.26. But that's not what they returned. It was only 12.92%. In fact, most beta segments above 100 matched or exceeded their projected return. However, beta segments under 100 or under 1 consistently underperformed their projected return. The story was just the opposite during the bear period of 2000 through 2002. Funds with a beta of 1 or 100 delivered a return of minus 15.20. Mathematically, I would assume that funds with an average beta of 0.8 would produce an average return of minus 1216. In other words, 80% of the loss of the index. Instead, they produced a remarkable return of only minus 4.75%, and it was that way for all beta segments below 100. Now, during the same bear period, funds with an average beta of 1.20 were expected to show a return of minus 18.24, but they did not. They produced an average return of minus 19.70. In fact, most of the segments north of 100 produced an average return worse than that projected. Were things any different in the bear market ended in February 09? Actually, the results were quite similar. In fact, funds that took more risk than the market performed worse than what was projected for them. All of the funds that took less risk than 100 produced returns better than projected. So what does this tell me about the worth of beta when selecting funds? Well, when it comes to beta, selecting conservatively is rewarding in a down market, and the lower the beta, the greater the reward. On the other hand, selecting funds for their aggressive beta is rewarded in a bull market. And the higher the beta goes above 100, the benefit grows better than projected, making the extended risk taken worthwhile. You know, it sounds like beta serves a great purpose when it comes to discussing age and risk tolerance with your valued clients. I think showing them these charts goes a long way to getting them to understand the role beta plays in your fund selection process. Well, that is it for now. I thank you for listening. I hope you will join me for the next webcast, where you will discover mutual fund selection trait number, I think we're up to 8. Fund selection trait number 8 is alpha. Until then, this is Jeff McTague reminding you, unless you can prove it, yep, it's just your opinion.
Right here, right now, right here.